Chapter 14 deals with the international financial system and the basis of trade, which is comparative advantage. However, if you remember back to earlier in the semester, we studied comparative advantage in Chapter 2. Because of that, we're going to be spending less time on that topic and more time on the international financial system. A quick note, while comparative advantage is the basis of trade, the international financial system makes trade possible. It would be hard for countries to buy and sell goods from one another if they were unable to convert their currency from their domestic currency to the domestic currency of the country they are trading in. Before we begin, let's take a minute to talk about international trade. As we just said a bit earlier, international trade occurs when countries buy and sell goods and services between one another. Here are some main facts about the U.S. trade in 2012. U.S. has a trade deficit in goods, or physical products. A trade deficit occurs when imports exceed exports. In 2012, the U.S. trade deficit in goods was $735 billion. The U.S., however, has a trade surplus in services. A surplus occurs when exports exceed imports. In 2012, the trade surplus in the services sector was $195 billion. If you add the two figures together, total net exports, or the number that gets reported in GDP, was a negative $539 billion. Principal U.S. exports include chemicals, agricultural products like corn and soybeans, consumer durables, semiconductors, and aircraft. Principal U.S. imports include petroleum, automobiles, metals, household appliances, and computers. Remember, a trade deficit will occur when imports exceed exports, and a trade surplus will occur when the opposite happens, when exports exceed imports. Now, despite the U.S. trade deficit, it happens to be the second largest exporting country in the world, trailing only, of course, China. The European Union reports its exports together because it operates as a trade zone. However, its figures are a summation from the individual exports of its multiple member nations in not one country. As you can see by the figures calculated by the World Trade Organization, China exports a little over $2 trillion in goods and services on an annual basis. The United States comes in at $1.5 trillion, followed by Germany at $1.4 trillion. As you can see, there are numerous European Union countries in this chart that also report individually. So looking at these figures, Germany is third. However, just a few years ago, Germany was this world's largest exporting nation, with the United States second. They were leapfrogged, and the United States was leapfrogged by China within the last 4 years. Despite what people think, though, Canada, and not China, is the U.S.'s largest trading partner. That seems to make sense, since Canada is a neighbor country bordering the U.S. to the north, and with the development of the North American Free Trade Agreement, which we'll talk about a little bit later, the barriers to trade between the two countries have been significantly reduced, meaning it's a lot easier, both regulatorily and logistically to trade with Canada than it is any other countries. As we initially discussed in Chapter 2, specialization in trade increase the productivity of a country's resources and will allow for greater total output and income. Specialization results in more efficient production, and because of scarcity, we have a responsibility to be as efficient as possible with our resources. Comparative advantage allows us to determine who should produce what. If you may recall, comparative advantage is a lower relative or comparative opportunity cost than that of another person, producer, or country. The terms of trade, or the rate at which units of one product can be exchanged for units of another product, can make both countries better off. And they can make both countries better off by allowing them to specialize or concentrate their resources on what they do best, which will ultimately lead to a surplus of production for which they could trade for other items or services that they need, but for which they would produce at a lower opportunity cost, thus producing them less efficiently. Because importers and exporters commonly use different currencies, it is critical that one or both of them can convert their domestic currency into the foreign currency to facilitate trade. Without that ability, there would be no trade, or trade would be very difficult, meaning all countries would be worse off without an international financial system. Without that international financial system, trade would be very difficult. Specifically, a foreign exchange market is the component of the international financial system where foreign currencies are exchanged and relative currency prices are established. An exchange rate, or the rate at which one country's currency trades for another, is determined within the foreign exchange market. Buyers and sellers interacting in international markets will exchange their currencies, and the intersection between the supply and the demand graphs, or the supply and demand schedules for currencies, will develop the equilibrium point, or market price, or exchange rate. Exchange rates, though, can either be fixed or floating. If a country pegs its currency to the US dollar, meaning that its currency is equal to a set amount of US dollars and does not fluctuate in the foreign exchange market, then it is said to have a fixed exchange rate. If a country relies on the foreign exchange market to determine its exchange rate, it is said to have a floating exchange rate. And as we said earlier, the intersection of the supply and demand curves will determine a floating exchange rate of one currency versus another. So let's take a look at an example of the market for foreign currency for British pounds. As you can see, the intersection of the demand for pounds curve, D1, and the supply for pounds curve, S1, determines the equilibrium or market dollar price for pounds. Here, in this example, that is $2 American. So this example looks at how many US dollars is required for 1 British pound. Looking at the graph, we can see that the exchange rate in dollars per pound is $2 to 1 British pound. The upward arrow demonstrated here is a reminder that a higher dollar price of pounds, let's say $3 per pound, caused by either a shift in the demand or the supply curve, means that the dollar has depreciated versus the British pound, and that the pound has appreciated versus the US dollar. The downward arrow tells us that at a lower dollar price of pounds, let's just say $1 per pound, again caused by shifts in either the supply or the demand curves, means that the dollar has appreciated and the pound has depreciated against one another. Depreciation is a decrease in the value of a currency relative to another currency. For example, it will now take more US dollars to acquire 1 British pound, meaning that it will cost more money to visit Britain, to buy property in Britain, or to shop in Britain. Appreciation is an increase in the value of a currency relative to one or relative to another country. For example, it'll take less US dollars to acquire British pounds. In this situation, it will cost less American dollars to buy property in Britain, to shop in Britain, or to travel to Britain. On a more current and practical note, in recent years there have been complaints that China has purposely devalued its currency for the sole purpose of increasing its exports. They are doing this through expansion of their domestic money supply. When the exchange rate for the Chinese currency, known as the yuan, is reduced, it makes Chinese-made products cheaper to foreign purchasers. In doing so, China can ensure that its factories keep producing, thus ensuring continued economic growth. Think circular flow model. This policy does have its disadvantage, namely the increase in the production or printing of the yuan will make domestic consumption more expensive. I will have a separate video posted analyzing the effects of a devaluation and appreciation of a currency and how it affects export-import prices. Now, you said that the intersection of the supply and demand curves determine the exchange rate. What are some of the factors that can cause a country's currency to appreciate or depreciate? From the demand side, it's tastes. Do we want to go to this country? Do we want products from this country? Relative income and relative price levels, interest rate policies, and speculation. Speculation is the buying and selling of currencies for profit and not for the utility of those currencies. Additionally, an increase or decrease in the money supply by either contractionary or expansionary monetary policy will either increase or decrease the supply of currencies or funds. The increase of supply in funds will, in fact, depreciate a country's foreign exchange rate in the floating rate system. Most countries enter into international trade agreements and form trade blocs. By doing so, it allows them to minimize or even eliminate, in some cases, the barriers to trading with another country. These barriers include regulatory issues or regulatory laws such as quotas, which is a limit on the amount of goods one country can import in a certain sector, and tariffs or taxes on products. The earliest trade agreement was the General Agreement on Tariffs and Trade, known as the GATT, formed in 1947, just after the end of World War II. This agreement was formed by 23 nations who agreed to give equal treatment to one another. They reduced tariffs through neutral or multinational negotiations and eliminated those nasty import quotas. In more recent times, the WTO, or World Trade Organization, was formed in 1993. It included 152 nations as of 2008. The WTO oversees the provisions of the current World Trade Agreement, resolves disputes that stem from it, and holds rounds of trade negotiations. The WTO attempts to make trade easier within its member nations. One downfall that the WTO has is that it may have some level of dispute resolution power. It does not have a level of police power, meaning if there is a dispute between two trading partners, the WTO can determine whether or not it's legal, but they cannot enforce the trade agreement. Other commonly known trade agreements and trade blocs include the European Union. The EU is a trade bloc that included 27 European nations as of 2008. The EU eliminated tariffs and quotas amongst its members, established common tariffs for imported goods from outside the member nations, reduced barriers to the free movement of capital, and coordinated on other economic policies. It also led to the creation of a single European currency or European Union currency known as the euro. Closer to home, the North American Free Trade Agreement, or NAFTA, was formed in 1993 and it is a free trade zone that includes the United States, Canada, and Mexico. As mentioned earlier, when talking about the U.S.'s largest trading partners, NAFTA allows for large amounts of goods to move across the borders at relatively lower prices. This means that the U.S. now has an incentive to trade with Canada and to trade with Mexico. This has led, however, to some drawbacks in some U.S. industries, specifically in the U.S. auto industry. Many factories that were once located inside the United States have now relocated to Canada or to Mexico. And even though these areas may have stricter regulatory laws in some areas, the elimination of the tariffs of moving these finished products across borders has made it cheaper for the auto manufacturers to make their vehicles in these countries as opposed to the United States. When people protest against the creation of these trade agreements, it is because they feel that jobs will be lost domestically and be shipped to other countries. In some instances, that is a valid point. However, because of comparative advantage and because of scarcity, a country needs to be efficient with its resources. If it cannot produce efficiently, it is better off concentrating in those areas that they can do efficiently. In the U.S. case, they can innovate, and they are much better at innovation than they are at production because of the expense associated with it. NAFTA has allowed companies to concentrate on innovation and offshore what they do inefficiently in hopes of making the final product as best and as affordable to consumers as can be. This concludes our look at international trade and the international financial system. As I mentioned, there will be a separate video lecture posted on the practical implications, on changes in a foreign currency on import and export prices.